Hello, this is Danvi from danvi-charting.com. In this video, we will look at how correct use of option can help you build wealth. So, title is Building Wealth with Correct Use of Option Trading. But before we begin, please stop the video and read through the disclaimer. In brief, any content and material included in this video and all other videos are only intended for illustrative and educational purposes. They are not interpreted as advice or recommendation, and that trading any financial instruments carry high degree of risk and they may not be suitable for everyone. So let's begin. There are different types of options. Some we may have heard of and some we might not have. Some of them are included here. They are one-touch options. These are basically during the lifetime of an option, the price is expected to touch a certain level just once and the option would mature. That's for the buyer of the option. Then there are other options which are barrier options used by many institutions quite extensively. They may be options where they only come into play if it touches certain barrier. Otherwise, they expire worthless. Then you may have options where during the lifetime of the option, it would only have any value if it, for example, either remains below a certain level or goes above a certain level. And these are more exotic type with multiple scenarios where financial instrument can be organized by some institutions or a bank which will offer different degrees of risk to the investors. So as an example, in UK, we have had in the past a form of a product where an individual deposit a sum of money to the bank and the bank would guarantee to return that at the end of 5 years, for example. And they would be given either the 100% of the capital back or they will be able to have a participation into an equity market rising. So what the bank would do is they would put that money in a deposit and then calculate what interest they will accrue during that 5 year, and then whatever amount of interest they accrue over the 5 year, they will use that to purchase some type of options. These options will enable them to have exposure to either a downside or an upside in the market, and then if those options have proved profitable, then the investor will be able to participate a certain amount of that profit. So he would either get his original deposit back or he would get a percentage of the profit that they were promised as a part of the options. So the bank would then make the money on the remainder of the profit they made in the options. These are exotic types and they have several different types of risks attached to it. So but for us, we won't be dealing with most of these. They are not for our purpose to help us trade so that we can build wealth from relatively minor account or very modest account. The option we are looking at are in essence falling in three categories or three types. These options are either European style or American style. And from these two hybrids, you will also see many binary options. The binary options may also be of the type where it is either one touch or a barrier option or just straight options. But the issue with these binary options they are often only available through that particular broker. So the broker would buy formal options from regulated market outside and then they would parcel it off into small pieces for their retail trading clients. And in general, they would carry higher risk because they are basically controlled by the broker, and likewise they would have wider spread and probably not be that liquid. So I would stay away from that. I know there are many who perhaps with a lack of knowledge and level skill, relatively new in trading career, somehow gravitate toward this binary option, thinking that it is good in a sense that the risk is very defined and clear. However, over a longer term, these binary options, because they never give you more than the 100% of your investment, it's a losing game. The most you can gain on these are something less than 100%. In fact, it's quite common for even the best winning trades, the broker would only give you 70 to 80% of the proceed. So it's good if you made a profit, 70-80%. But if you make a loss, you lose 100%. So really, they are not the sort that I would even waste my time on. But out of the two others, we would avoid the European style because they are only exercisable at the end of the life of the contract. Whereas we want to be in and out, and therefore they are not suitable. So we will focus on American style options. In American style options, it allows the buyer to enter the market and exit the market at any time during the lifetime of the option if it is profitable for him to do so. But he has no obligation. So in a nutshell, the American style options are a contract where the buyer of the option, whether it's a call option if you think the market is going to go up, or a put option where you buy these if you think the market is going to decline. So the buyer of the option has to pay the premium to have that contract. And on the other side of that trade, it's the seller of the option. The buyer of the option has the right to exercise the option if during that lifetime he feels or she feels that they have a profit to gain by exercising the option. But they do not have the obligation to exercise, because if it is not advantageous to them, they can let the option expire worthless. Whereas on the other side, the seller of the option has an obligation to honor the contract if exercised against him. So in general, we would only be the buyer of the option. There are many extremely skilled and knowledgeable traders who may actually prefer to be just seller of the options. The reason for this is because based on the industry data that nearly 80-90% of the options expire worthless. So they think that if such a high percentage of the option expire worthless, it's best to be the seller of the option, like an insurance company, where by getting small premium they become a seller of the option. But the risk is high on a particular trade if, for example, a claim is made, an insurance company has to pay out a chunk. So they are not the kind of options or the strategy rather that I would promote as a sort of a naked trade, which is just becoming a seller of an option by itself. We may be able to combine that on occasions when necessary to buy an option and sell the option against that in order to reduce the risk where we are not certain about the likelihood of the trade, or that we want to reduce the initial outlay whilst we are waiting for further confirmation of the trend developing. So in that case, you would, for example, have an option at a strike price of say 100, and you think the market is going to go up. So what you would consider is you would buy maybe not 100, but you would buy something like a 105 strike option. But against that, you might sell 110 strike option. So in that way, we could sell the option, but we would not be the seller of the option by itself. only the buyer, either a buyer of call or a put option. So what are the characteristics of the option? Well, option is a contract which is typically viewed as a wasting asset. Why a wasting asset? Well, as a passage of time, if the price doesn't achieve your intended objective, then essentially it could expire worthless. So in that sense, it carries a high degree of capital risk. The 100% of the premium could disappear. You could explain this briefly by having an illustration of, say, a bucket where you have some holes at the bottom of the bucket, and over a period the water continues to leak from the bucket and to the point where eventually all the water would disappear. That's basically what the options are. With passage of time, they continue to decay to the point where they become worthless if during that lifetime it hasn't achieved your objective. So it does carry a higher risk. How are they priced? The main factor in pricing is the prevailing interest rate, because it is deemed that if you were to invest your cash balance in a bank account, then at least your capital is guaranteed. Although we understand that due to inflation, the buying power would be reduced if there is inflation. However, nominal amount that you have deposited is guaranteed. And in that sense, it would also accumulate whatever level of interest that is currently prevailing. So it's viewed as risk-free investment. And therefore, that interest rate is considered when pricing an option. Secondly, what strike of an option are you buying? So for example, in the case we were looking at a unit price of 100, if you were buying a contract with a strike price of 100, it is called buying at the money, which means where the price is now. If you were to move up or down that strike price, and depending on which direction, assuming that you have an instrument that is moving up in a strong bullish trend, so currently it's at 100 and you think it's going to go to 105 or 110, and you buy a strike price of 105 or 110, then they are considered out of the money. How far you go out of the money will have a bearing on likelihood of that particular option ending its lifetime reaching its objective, i.e. 100. So or 105 or 110, and the number of units you go out further out reduces the likelihood of those prices being achieved, and they are referred to as delta. So if you buy it at the money, then you have essentially 50% chance of expiring contract with the price being at 100. If you go out 1 unit, it may be that you have a delta of 75, meaning there is 75 chance of a price expiring at 105, or rather price reaching at 105 by the expiry of the contract, and so on. So what level of delta, how far away from the actual price you are selecting an option, have a bearing on how it's priced. Second most important component is also how long are these options going to be. So in essence, if you buy an option that is only going to last 1 week, then they would be very cheap in comparison to something that will last you for 1 month or 3 months, and so on. But as the time passes, the value of these options continue to drop. So they are essentially called time decay, which is where the illustration of a bucket we're referring to. With passage of time, the value of the options continue to reduce and eventually go to zero. And the third most important element is the volatility. And there are 2 types of volatility. One is historical volatility, which is based on how the price has behaved in the last, say, 2 or 3 months or longer. And there is implied volatility. So historical volatility looks back on what has happened in the past, whereas implied volatility looks at what is going to happen in the future. And a case in point would be is if a particular stock has an earnings announcement coming, then during the earnings announcement, either the outcome would be is that the data would be better than anticipated by the financial community, and in which case the prices would go up, or it could be that they were disappointing. They were not reaching the expectation of the financial community, and therefore they will be disappointed. So you would find that they would drop. And sometimes these moves are fairly dramatic. And as a result of that, the implied volatility just before the earnings announcement tends to be quite high. So buying in any options just before such event tends to be more expensive than ordinarily they would be where such events are not anticipated and the implied volatility is close to or near historical volatility. So the point of this is that we would tend to buy options before such implied volatility begins to explode, because just after the event, when everything becomes known, the implied volatility which was increased in anticipation of what will happen on earnings announcement could easily drop. So we call this volatility crush. We'll cover this in a moment. So we would prefer to buy them when the implied volatility is close to historical volatility. Usually these would happen when, for example, the stock price is not moving very much, or is in a congestion period, or it is moving but with very clear defined sort of steady run of the price progression. This chart illustrates how the options would decay. So for example, you see on a chart here to the left of the scale is the unit price at 5.3, and you generally have like a steady downward trend, suggesting that, as this is by the way for options with a strike price at the money where the market is now. So if you buy a stock option at the money, this is the actual illustration of how price would decay. Steady declining trend, and then into the last 30 days of the option it begins to take even more steeper decline, so exponential curve to the downside. So the point of this is that when we are buying an option, we would tend to avoid staying with the option in the last 30 days of its lifetime, if possible. Sometimes there may be reasons why you might want to stay in, but generally speaking, where we have the choice, we would tend to avoid being in the option in the last 30 days, because that is when the greatest amount of value of the options expire or decay for options that were bought with strike price being at the money. Slightly different is if you were 1 unit or 2 unit or more away from where the price is now, then it is called out of the money options. And for out of the money options, the decay is similar, except that instead of taking exponential down curve in the last 30 days, it doesn't decay as much, simply because so much has already been lost. So there is very little to decay. So from that perspective, it's the decay curve doesn't steepen, but it sort of flattens out. But these make no major difference. As far as possible, we would avoid staying in the last 30 days of the option contract. Therefore, as you can see from these, that trading options are relatively high risk, since you need to get several things right. One, you need to anticipate and guess the correct direction in order for you to decide whether you should be buying a call option or a put option or an option spread. How far is going to move? This would help you to identify what strike price you should be looking at. How long will it take for that move to transpire? And hence, this will help you to decide what length of contract you should consider. So these three things are quite difficult: getting the direction right, how far it's going to move right, and also getting right how long it's going to take for that move. But in addition to that, we also have a pitfall of volatility drop. As I mentioned earlier, that just before an earnings announcement, the implied volatility could be very high, and immediately after the earnings announcement, implied volatility will begin to drop rapidly. So in this scenario, you might have price move in your direction. So you are right in what you were thinking the price will do, and yet you would actually end up with price of the option that you paid for lose value, so which is called volatility drop or volatility crush. And we have a spread of the options. Some of the liquid stocks have spread that are fairly narrow, but even then, during the high volatility events, the spreads generally tend to be wider. So you could easily lose a good amount on that spread, even though price hasn't gone anywhere. So simply just buying and selling immediately, you will incur a loss because of that spread. And then the broker will have a dealing cost. Often they tend to be a minimum amount plus something to represent the size of your trade. Or some of them may just have anything up to certain size, everything has a fixed cost. So it could be $5, could be $14. So on a very small account, obviously you will be taking relatively small trades. But then these trades would struggle to make decent profit because a good chunk of this will be taken away in trading, both buying into the market, paying the dealing cost, and then exiting the market, paying the dealing cost. So in addition to the three major problems we mentioned about direction right, extent of the move, and the time, we also have this additional pitfalls or negative things that would impact us in trading options correctly. So due to these points that we just covered and the nature of these options and different factors that impact it, if we are aware of them, we could still use options because they have a different risk reward for the buyers and sellers of the option. The sellers, they will look at it from the point of view that if they have 80 or 90% of the option expiring worthless and they continue to do this on a long term, properly, well managed, then they're like an insurance company. They could still make money, but they carry substantial risk with it. And the buyer of the options have a different risk reward because the most they can lose is the amount they put in, but hopefully if they get things right, they might get more than the 100% of the money they laid out, and hopefully a lot more than just the 100%. So the options have multiple uses. Individuals can use it to do speculation in the market, to take advantage of some strong trends. Portfolio managers might use them, or individuals can use them in hedging the portfolio. So if you have a portfolio of stocks and you're worried that the market may make a substantial retracement, then you could buy options either on an index or individual stocks to hedge that position. So they can have a different outcome. Also, many complex strategies can be used. Some, for example, will use options in a very range-bound market using multiple legs. These would obviously require a lot more skill level and knowledge and resources in terms of size of the account and the time to manage them, but they would definitely be suitable with added complexity. So we could use options to correctly design a trade for either a ranging market or a directional single leg market, or we could use it for multiple legs. So all of these different types of trades can be traded using options. But the simplest form of trading options is buying either a call option or buying a put option. And doing so with a well-researched trade would be the simplest form. As your knowledge would grow, you would, or you might wish to try out these other complex strategies. But to my mind, if you want a type of trading method which is relatively simple, doesn't require a lot of time for management, and could be traded with relatively small account without having to worry about margin and other things, then you could actually just trade options, buying calls or buying puts. And in doing so, you would be able to trade them fairly simply without excessive stress and the level of time and research involved, used especially on a larger swing trades. So what are the advantages? Advantages are that with a very clearly defined risk reward, you could either hedge the portfolio or you could speculate. Individual with relatively modest account, i.e. Account even less than $5,000, but then, as I said, because of the size of trades you would take, the dealing cost might be disproportional. So ideally we would say maybe say $5,000 or $10,000 as a modest account. And even somebody with that size of account can trade successfully and build the account over a period using options and selecting to trade by buying options in call options or put options on a well researched, well planned trade for longer swings. What options also allow you to do is take advantage of the leverage, meaning that if the market goes in your direction and you have a certain outlay on it, the chances of you getting a reward as a multiple of that particular outlay, like 2 times, 3 times, is quite normal. Certainly not impossible at all, but more likely you could get 5 or 6 times or 10 times, and on occasion be fortunate to score even higher. So in that case, you will be utilizing the leverage available by the way the options are designed. You would not have to worry too much about adverse drawdown in a whipshot market or being stopped out prematurely. Many times it may be that you could identify a correct trade, enter, and have been out by a few days or a week or two, or maybe even a month, during which time the market would continue to oscillate, and possibly in a normal situation you might have a stop and this could take you out. But with the options, because you are not worried about adverse drawdown against the remaining cash balance on your account, you could withstand that. And you could allow the time to work for you, for the trade to begin to unfold, hopefully in the direction that you traded, and become profitable. If, however, you found that you were wrong, then you can still exit the market with intention of maybe salvaging some element of the premium you paid. But certainly you would not be worried about being adverse drawdown or premature stop loss being triggered. And it allows you to trade bigger swings, long-term swings, without having to spend a lot of time monitoring the trade. Trading smaller time, like 15 minutes, 1 hour or less, would mean that you are having to monitor the market all day long. Whereas if you're trading a bigger time frame for bigger trades, swings, which could last you for several months, you might not initially need to even review them on daily basis, maybe just once a week or a few times a week. But if you're very active and you're interested, you might certainly not need to do any more than checking it just once a day. So in essence, it allows you to benefit from this. You can carry out various analysis monitor the several markets at the same time. All this without having to spend extensive hours at the PC. So you can continue with your normal secular and domestic commitments. If you are working, you can keep your job and you can continue to trade these bigger swings, because it doesn't take this or extensive time in order to both plan, research, etc. This can be done on a regular basis, spending just hour or two, if that, or over the weekend, and monitoring several markets in which you are engaged, and also with some shortlist which might be showing promising trades that might develop. So the drawback of this, as we've just said, is interest rate, probability that the trade you have taken might not get into profit, i.e. the delta would suggest that you have a very high risk of losing money before the expiry. As the time continues to decay, the value drops if nothing else happens, and the volatility, spreads, and dealing cost. These are the drawbacks against the potential rewards we were just considering. So overcoming the drawbacks or disadvantages by considering these, trading larger swings means that you won't be trading so frequently, and hence you obviously reduce both the spreads and the trading cost involved with it. So that would certainly help in managing that drawback. Buying the options when the volatility is certainly the implied volatility or the future volatility is closer to the historical volatility, where you are buying at a reasonable value, or if you are buying at the time when the implied volatility is high, then maybe buying a spread. For example, the spread we mentioned, like if the price is at 100, you might buy a call option for 105 and sell call option for 110 to somebody else, and in that doing so, you will be partly offsetting the extra premium you are paying because of the high volatility by selling the 110 call option at the same time. The other major way in which you can overcome the disadvantages of the options is having a multidisciplinary analysis. This would include technical analysis and fundamental analysis. I don't pay too much attention to fundamental analysis specifically, although I don't dismiss it. But if any of you have necessary skill level and desire, you can build in fundamental analysis to go along with your technical to identify particular trades. But the common technical analysis, like most are aware of, such as horizontal support resistance, trend line dynamic support resistance and channel lines, or the use of oscillators for gauging momentum, Fibonacci, for example, both for retracement and extensions and projections, overlaid with Elliott waves. I particularly like Elliott waves from what I know and have used. I think they can be a great advantage. A certain type of price structure would suggest something to you regarding the future prospect of that particular instrument and its price behavior, and it could even indicate likely price targets. So when you understand them, they can be a great help in overall identifying the price structure of the instrument, and then using other technicals to help you clarify and confirm. One area which most traders do not spend much time in are what I call intermarket correlation analysis and ratio analysis. In brief, intermarket analysis would be, for example, looking at the internals of the market. So if the market, for example, is rising, the Dow Jones or S&P 500 is rising, then you see how many constituents or members of that particular index are also rising and in a bullish momentum, or are several of them now losing steam, in which case the main index which is composed, of those constituents, would also soon begin to wane the momentum, and possibly market would either reverse or retrace. The other correlation would be is where you identify a particular instrument having similarity to the other instrument. So as an example, you could be looking at S&P 500 and say Nikkei, and both of them have a strong correlation. Sometimes you might find that even though they are correlated, occasionally either S&P 500 or Nikkei index may lead the turn. Sometimes they give you a week or two advance notice, sometimes there can be few months advance notice. And this could help you to be on the alert and look out for other evidences to confirm. Likewise, for example, if you look at oil, you may be looking at US oil and UK oil. And occasionally, because they're both oil and they have very close relationship, 100%, well, not 100%, but certainly very high ratio, maybe 90-95% correlated, you would expect them to do the same thing at the same time. But when you chart them together, you will find that sometimes one of them, for example, makes a small lower low, where the other one fails to do that, and that could give you a warning that potential divergence is at play between the two instruments, and chances of the trend exhausting, and maybe at least a retracement is in order, or perhaps a reversal may be on the horizon. So these kind of correlations are very, very useful. If you identify a particular trade with the other instruments, then this correlation can help you to clearly define and either confirm or help you clarify the traditional technical analysis. Another form of intermarket analysis is ratio analysis. So what I mean by that is, for example, if you found that the precious metal have bottomed, like gold and silver, and that they are now likely to trend higher, you might want to see if they are both bottoming at the same time, or are they one of them bottoming earlier or later. So in addition to the correlation study we just mentioned, you can do a ratio chart, and the ratio chart will suggest to you that the relationship between gold and silver is such that it has like an upper level and a lower level, and basically the ratio would oscillate between that. So historically, you can find that silver could be cheap in comparison to gold, and that would suggest that if you are expecting silver market and gold market to go up, then it would favor that you would buy a silver, because silver is at the lower end of its historical range. And similarly, if it was at the upper end, then you might consider that the silver is too expensive historically in comparison to gold, which would suggest to you which instrument you might want to use. And those also show a similar price structure, and you could probably do normal technical analysis on them too, like retracements and Fibonacci ratios, trend lines, even Elliott waves. And the third way in which you can reduce the negative of trading options is trading a wider market, i.e. trading markets that are not all related together in the same cycle. You might wish to trade market which are either negatively correlated or not correlated. Also, you might have trades introduced into your portfolio at different times. So some trade, for example, might be coming to an end, whereas the other trade might be just developing. So these would help you to diversify, because you are not looking to enter the entire portfolio at once. In fact, you would probably not want to even use more than 50% of your capital value maximum investment at any one time. What this does, it allows the amount invested to have different cycles of each part of the portfolio, as well as if a certain trades develop, you always have capital available for you to consider. So these are the ways that we can try and use to help navigate the pitfalls of trading options, where supposedly 80-90% of the options expire worthless is what the industry data suggests. Now, if we were to adopt this multidisciplinary technical analysis approach, obviously these are not easiest thing to do on a smaller time frame. So they are best suited for a longer term and longer time frame, like daily and weekly time frame and even longer. Pardon me. Will they work? Or is it just theory? Well, let me show you a few examples. This chart you see is that of Apple before Apple had a recent split. So in this chart you see that the Apple reached the level of 700 and then subsequently it declined. Based on the Elliott wave, it suggests that when this 5-wave cycle completes, it retraces back to the wave 4 of 1 cycle degree lower. So what that means is that we have a high made at 700. So immediately we would be looking at, if that was the complete cycle, which I think is a rising wedge. I haven't drawn it, but you can see it's a rising wedge where you have a narrowing down of the range as it goes up. And in Elliott wave, they would call this particular pattern a rising wedge consisting of 3, 3, 3, 3, 3. That means every swing is made up of 3. So you have a 3 swing up to here to make one wave, 3 swing down for wave 2, 3 swing up for wave 3, 3 swing down for wave 4, and then 3 swing up for wave 5. So it's a 5-wave move to the upside. So this would be where you would expect the retracement to end. So when I charted this one, I was looking at this narrowing range as well. So I was suggesting that this was ABC, but with a hindsight, because of the way in which this price actually developed, it might have been better to label them as W, X and Y. So basically a zigzag to wave A, retracement wave B, and then really zigzag for wave C. But we would call that WXY. Anyway, that's beside the point. The main thing to take note of is that I had several fib relationship confluence at this level. It was also within the vicinity of the previous wave 4, and it was developing this, what I thought was a minor falling wedge. And that's why I labeled it ABC, and that's what I was expecting. So now what we have here is a potential reversal. We also had a significant trend line, as you can see, basically a trend channel from the lower prices, and it was coming in that area. So I concluded when I published this particular chart, you see it was done January 27th of 2013, that we could be expecting a resumption of this big bullish trend with every intention of retesting the high. So when this, on the announcement, there was a gap down here, and my interpretation was that that gap down was actually an exhaustion gap. It's been declining for so long, and that's an exhaustion gap, and that the price would then continue to go up. So during that period, even if you bought it before the gap down on the earnings around this level, you could have bought out of the money option, like say here. So when this price was around about 500, you could have bought like a 570 or 600 call option, and you would not be stopped out. You will have bought them with adequate time, of course, because the market goes up slowly in comparison to how it comes down. So you could allow maybe say at least 12 months or 18 months, maybe 2 years, and you would have caught the biggest part of that move. I'll show you on the other chart how that actually played out. But you know, if you were able to check a Apple chart, that once the price, once we had reached at this level, and the Apple then split into 5, resulting in share dropping this one down, sorry, 10, I think, split into 10. So the share dropped down to value of 50, and then it went on to make about 120 or just north of that. So it's significant move. You could have doubled that, you know, your purchase price on Apple share directly, but your options would have multiplied by magnitude of something. I couldn't give you the exact figure because I haven't got the data for this, but you could estimate that if this was to play out, and if this was in the after the split, if this was at 50 and you bought a price option of somewhere around here, like about $60, and it went on to make about 120, at least your value, whatever you paid, would be the difference between 60 and 120. That's a $60. And this option might have only costed you maybe at best something like a $5 or $6. So you're looking at like a multiple of 10 times in the course of your couple of years, and not worried about adverse drawdown, stops being triggered. And I'll show you on the live trade how the actual price chart developed from this low that we see here. To help you see that this analysis using several different approach would have worked. We've got like a oscillator diverging, several other trend line supports confirming, and the wave count. So all was giving a good reason why a potential long trade could be considered. This is the chart of the coffee, and I will show you the live chart again and show you how price moved out. But in this one you can see that it moved down, and this final part is a falling wedge. So this falling wedge means that if it once it complete, the price would at least go back to the origin of the falling wedge, especially in this particular setting, because this I think is probably a 5-wave move down, like 1, 2, 3, 4, and then this wedge being wave 5. So if that's correct, we would be expecting a price to retrace back to this sort of level, from here at 104 or somewhere, and then you can see it went up to about 200 and something. But we were estimating that it would go to about 190, maybe 200 area. So if you had looked for a trade, we could have entered that and exited it here, and it happened so quickly. As in fact, some of these commodity, when they make a move, they move really fast, like that one and this move here. Even this one, relatively speaking, is fast. Some of these up moves are very strong. But anyway, if you didn't, then the next thing would be is that we had this wave move down, a zigzag up, so we'll expect another leg down and potentially give us another trade at the lower end of this chart. And on a live chart, I will show you how that particular trade, how this transpires. So actually, it is now in a region where a long trade could be considered if you didn't take this one. So you can see how this analysis actually help. Similarly, this gold chart, I posted it when the price, you can see, was in this area. It's actually a chart I posted in the trading view. You can go back and have a look, and I will show you how this price developed in a second. But there were so many reasons why I was expecting a breakdown of this trend line, which is a big long time frame line, also having dropped down, retraced in a zigzag, made a lower high, and is now coming down to break this trend line, suggests that there is a lot of downside to the move. And I'm very cautious generally when I chart these, so I don't go for big targets. So in here, I was expecting as a minimum simply to retest the previous area of support. But I was also prepared for this price to drop down to somewhere in the region of 1200 or 1100 area before the entire decline completes. So that's why you see this up arrow here, but it's not necessarily an up arrow to suggest that we would have necessarily gone long at that, but it's simply to say that, based on what has happened here, and if it transpires, it would give me enough to feel that maybe this move is over. That's a minimum expectation. But because it has already moved this far down and retraced, you could expect a similar size of move to the downside, which means that it would be well below that zone. And how did it play out? Well, that's the same chart reposted again. This is the area when the price was. We were expecting it to go drop down to retest that zone here at 1500, but in essence it came down a lot more. And as price actually broke on a retrace, we would have had an opportunity of plotting the chart that I have plotted here, and the drop came here so fast that the trade, if we had actually entered a put trade, buying a put options, it would have resulted in a substantial profit, and we would have, because of such a steep drop, we would have taken it and exited the trade. When you get a steep drop or steep move like that, you don't then hang around, because often what happens is retrace, it may congest like it did here. But even on this particular trade, I was expecting that some kind of a congestion and another leg lower. And as I said, I am cautious, so I don't go for big targets. So I was only looking for 1300. But in essence, now that we've got this one, you can see there were lower targets here below 1200. So I had my bigger eye at around about 1100 zone for a possible termination of this decline. Not necessarily just stopping there, but overall this trade would have been profitable. So using analysis in the manner that I am suggesting, which are combinations of general technical analysis approach of trend lines and channels, support, resistance, etc., along with the confluence of Fibonacci's, even the pitchfork that I shown here has worked really well, because when you actually look at the price chart, you will find that the price actually dropped below and came to the lower parallel of the pitchfork. Now if that coincided with some other technicals, it could suggest an area of possible reversal. So that's the end of the slide presentation. I'll go on to the live charts now. And this is the price of the Apple. When we were talking about the low being here, and there was a split of 1 for 10, so from 700 the price dropped to like 100 here, and then when the price dropped here, it actually only scored like 50. But essentially that's where the price was when I was suggesting a leg to the upside. So here we wanted a 5 may move up, at least to retest the previous high or make a new higher high. We subsequently identified once this leg was up and we did the retracement. So based on that and based on this decline, we identified a confluence which was somewhere about 130 area where we would terminate. So based on that, we could have had a trade going up and we would have been profitable. So you could imagine if you took a call option of anywhere around 60 when the price was down here at 56, at 60 or even at 70, the stock would have doubled from the strike price. So your option would have worth at least 7. So like I think it could easily have 10 times multiple. And what time did it take to do that? From June of 2013 up to the high of April 2015. So maybe just under 2 years, 18 months. But you know, bulk of the ride, even if you had 18 months, the bulk of the ride would have been there, and you would have been happy to come out with maybe 10 times the multiple of your original outlay without having to worry too much about the stop losses. So and then I have also subsequently posted the chart a little bit premature again, expecting a top to develop somewhere just above the previous high in the region of about 120. So then this one went on for another $10, but I'm expecting now some kind of a zigzag down back towards the level of this 50, or maybe make a small lower low to the downside, suggesting potentially a short trade. If my wave counts are correct, we could be looking for a drop of this back toward this previous low here. So substantial trade in the making. We could get a couple of opportunities. Even this one will come close maybe, then do a retrace bounce and then come back for a second. So regardless, we have a potential short entry in Apple. Even if we don't move now, we'll wait for retracement and then take a short trade for it to come to somewhere about 70-80 area, do a retracement and then eventually drop to about 50 or 40 area. So that's the way I'm approaching. I'm taking a bigger term cycle. Sometimes the trend will last you for maybe a year or 2 years. We talked about a gold chart. So this is the, sorry, my apology. This is the gold chart. So when I published the chart originally that I showed in the previous slide, this is where the price was. Okay, and then subsequently I was expecting at least a retracement back towards this zone here, where we had like a triple bottom. But when we got there, the price actually shot through and dropped so steep. You can see that we would have either exited maybe on that big week, or the trend was still down, and you can see there was no real divergence on the RSI. This is the weekly chart. So you can see if you drew trend line on this one, because on price is a bit difficult. When the price is falling so steeply, it's difficult. And I find often that trend line on something like RSI do a really good job in helping you to picture in your mind's eye that we are still in a downtrend. So as long as the RSI remains below that, you are basically short. So you could have had bulk of this move captured, and then we went into this sideways pattern. When I showed in the other second slide that we were expecting some kind of a congestion, and this congestion didn't develop into the triangle that I was expecting. But if it was a triangle, it would have done a proper triangle. So although this looks like a triangle, but in Elliott wave terms is not really a triangle. But what this one did was a zigzag, and I think the zigzag is that we've got a retracement. We got a drive up, a retracement which came below the previous low, and then when it came back up again, it didn't go beyond the previous high. So I call this one like a running flat, the Elliott wave term, running flat, suggesting weakness in the market. And basically then after that we've got a 5-wave move to the downside. As you can see, I've labeled it wave A, wave B, wave A here, wave B there, and wave C. And in the wave C, I'll draw a little boundaries here to help you picture it. And you can see that it's got a 3 swing down, retracement, 3 swing down, a retracement, and a 3 swing down again. So it's a triangle falling wedge. In Elliott wave term they call it 3-3-3-3, which is 5 waves, but they're all consisting of 3 swings, suggesting also that that falling wedge could be over around that sort of time. This brown line you see is actually a retracement of 50% from the low of 2000 to the high of 2011. So we have 50% retracement there. And then in terms of showing you how Fibonacci projection would work, is that we measure this swing here and we apply it from the high of this swing here, and we get 178% and 200%. It didn't get to 200%, but 178% came close. Then we can do fib extension. So for example, a fib extension, this is the dominant trace back, so we could actually use that swing and do fib extension. What fib extension actually mean is that normally we apply this one to suggest there is a retracement. We normally do this one to suggest the retracement coming. What happened? Give me a second. Okay, so if the retracement is like 50% of the drive up, or 61.8%, or it comes to 100%. If it came to 100%, it come back and retest that low. So now as you can see that we have 144%, and if it went to a little bit lower, we would have had potentially around about 1024 as 161%. So this 178% and 144% extension of that, and the 50% retracement of the high to low from 2000 to this 2011 high, along with diverging trend, diverging momentum indicator, and as I said, like a line on the oscillator, suggests that we have clearly broken out. Regardless of where you draw, this one is clearly broken out. That tells me that we have a potential low in the gold. Now if you were to consider going long on gold, if it does what I think it will, we are expecting a 5-way move to the upside to probably retest that previous high, maybe make a new higher high. But in doing that, it would have to follow a 5-wave swing to the upside. So it will have to do something like wave 1, a small retracement, maybe wave 3, another retracement, and possibly final wave 5. That's what I'm looking for, 5-wave to the upside, either to retest that high or make a new higher high, maybe around about 2000 as a round figure, or maybe slightly north of that. That's not particularly important. Or what we might have is that this whole move to the downside has actually been part of a one larger leg down, larger zigzag down, and we could maybe say call that one larger wave A. Okay, so this WXY, W here, X and Y, with A, B and C as one larger wave, then alternate would be is we would go back and then drop on the next leg. Now I don't know of the two which one, but I am currently favoring the 5 wave move to the upside, and because of that you will see I have posted a chart, this particular chart, just a week ago, explaining why we can expect a 5 wave move to the upside, and possible targets as being the first target of 1350 somewhere, or 1400, maybe somewhere about 1580 to 1600, because that's where the previous support was, maybe the third one, and ultimately the 5 wave cycle up. And I think that this would complete the, will a little difficult to go into great details with limited data, but I think this 1980 high was probably a massive cycle, wave 3, and then this whole 20-year almost to 2000 low was a big wave 4, and we are currently forming a big wave 5 to the upside, and in which we have done wave 1 in blue here, wave 2 in blue, this 2011 is a wave 3, and I think this is a wave 4, and we could be then heading for a wave 5 to the upside. So either that or this scenario, whichever one, retrace and then have another leg drop. If it is going to be another leg drop, this retrace probably won't be so sharp. It might be less steep once this initial leg moves out, and then possibly drop like that. Otherwise we'll continue to move up, but we will get further idea about what's happening once we get this wave 1 done and we get a retracement, which is when we would look to enter, because if we haven't already entered, we can't enter here, so we have to wait until it goes up there and it retraces and forms a low, because that's when the volatility will be low, and we can enter a long trade with a put option, possibly say around about 15 or 1600, and then see how it reacts when it gets to that area. I'm highlighting is basically where previous support was, so we can go into that, bump into it, find a resistance, and then it would drop down quite significantly, because from this area it dropped here to the second leg down, could be taking us to some big number like that. But I'm not expecting that, for the reason I just explained, based on my wave count, and also based on my view of dollar, because one of the reasons why gold has suffered is because the dollar has been very strong. So anyway, I think this is enough to illustrate how the technical analysis work. I'll give you a quick couple of other examples. We saw coffee, for example, that we looked at in the slide, that we had this particular retracement to the upside, then its decline back toward the rising trend line, possible support, and also in an area where previously there's been a lot of support or price actions in that area, where we've had a support, resistance, support again, and we are coming back into that area. So it's quite possible we could actually form a low for the price then to go back up. So this would be like a leg up, a retracement, and another leg up. So we will form a zigzag to the upside based on this chart. But because the coffee future contract would be big size, we wouldn't want to take an option on a coffee contract, a futures contract, because that would be fairly expensive. So what we would do is we would look at coffee ETF. So this one's supposed to mimic the price of coffee, and the only reason why I'm using the coffee futures is because it's got a price history going much further back in history, and therefore it gives you greater prospect of analyzing this. And based on this chart, you can see that the higher levels where coffee has often spiked, and secondary level where previously minor spikes have been made, and an area where it has done a rally from. So we can be in a good area for forming that particular or rather planning for that particular trade. So here now we have a coffee ETF. You see the wedge that I was explaining in the coffee futures chart, and it did this sharp zigzag to the upside. So again, what we have done is we have this swing down, applied it from here for a price projection. We didn't quite get to 786, in fact, and we overshot 618. Okay, so I think we overshot 618. You see, overshot 618 by a small margin, and we went up. But now we are coming back down and breached that one. So the next level to look for is 786. And then also looking at this swing to the upside, we're using price extension, i.e. price retracing more than the 100%. So the next level is a 200% coming in that proximity. 178% would be higher because we've gone through that. So now we are just bouncing along on that 200%, or if it made any further decline, then we'd hit the 78% and 200 let's start again, 223.6% to come into that area, essentially forming a zigzag down to suggest that we could be going back up to retrace this high, or more likely we can go there initially. It would probably do a retrace, and then we'll go up much further. It won't, because these are big massive cycles. You can see 2011 right up till here is nearly 5-year trading for this swing. So this is not going to happen in a couple of years, but certainly we could go in with an initial contract of 12 or 18 months time to ride this particular one, and then exit around that area. And you can see that when the market goes up, it seems to shoot up very sharply, like I showed you in the slides. So this is another trade in the making. So trading different markets. So for example, while these are connected because they are denominated in dollar, i.e. the oil or gold or coffee or any other commodity are denominated in dollars, so it does have some correlation, but the way in which this cycle move is different. Coffee cycle is different from its planting season, harvesting season, to what the gold is doing and to what the oil is doing, for example, and they all have different seasonals. But at this particular time, it seemed that possibly oil, gold, and coffee and other soft commodities might be synchronizing, because the dollar is, I think, topping either for significant retracement or in a complete new bearish cycle. So hence the all correlating together that they are in a potential formation of bottoms in that area. The other thing I was going to show you on this coffee chart is, you see many significant moves is at the beginning of the year. See, like February, January, this sharp move from there. If you look at this sharp move here, is again at the same time. So we are now coming at the beginning of the year. So we could be expecting a very strong sharp move. Monthly chart. So this sharp move, for example, was over in about 3 or 4 months, 5 months maybe. Similarly, if you look at this one, it lasted for a few more. But you can see when it moves, it can move really sharp. So although we have 12-18 month contract, we might find we'll exit that much earlier. If you look at any other, this one here, not quite at the beginning of the year, but if you take it from this one, then essentially we're in an area where it is back end of the year and earlier of the next year. So in that sort of scenario, so I'm suggesting that this is probably a seasonal pattern where coffee may be making a low, and there is a website where we can check the seasonals of these different markets to help us as a part of our intermarket analysis. So I hope this all helps you to understand how multidisciplinary technical analysis approach work, without necessarily taking too much into account the fundamental aspect, although they, as I said, I wouldn't dismiss them. There is a lot more you can do, but this kind of deep analysis can only be done on charts where you are trading a longer term. You can't do this on 5 minutes and 1 hour and 1 day, because you just don't have enough time and there is just too much to do, and your chart analysis would become obsolete by the time you finish your analysis. So I think that trading bigger swings, one, it enables you to trade big swings, so reduce your cost for trading by not having so many trades, so trading cost is reduced. Even a small mistiming can be overcome, because you know, if your trade is only short term, timing is very important. On a bigger swing, even if you were in a little bit too early, you have a long enough time to wait and see the trade play out. So there are so many big advantages in trading big swings, beside the major one being that is less stressful, and it allows you to continue with your life's commitment in other activities, social and secular. So overall, in this brief and very broad overview of options, I hope that you have managed to get the framework of what options are and how they are constructed, what characteristics they have, why are they risky, and what risk factors you need to take into account before you consider trading options. But by employing other means, how you can manage or mitigate that risk, and certainly use them to help you grow your account and overall wealthy over a period of time. So I hope you like this particular video, and that you learn something very useful. Even if it means that this gives you a framework, then it allows you to now do your own research, and there is a lot in the internet that you can read about options, some good and some bad, like everything, but hopefully you will pick up enough. If you have the framework, you can start putting all pieces together to hopefully develop a full picture that you will be very proud of, and which will enable you to then possibly start practicing this on a paper trading account until you develop adequate skill for you to employ the learned skill and ability in live trading accounts and grow your wealth. If you want to continue to be informed about future videos and other training materials that I will publish, please ensure that you go to danvi-chart.com. Getting myself muddled up. Just hold a second. Go back to danvi-charting.com and register there your interest. Leave any questions or any area of interest you may have, and then when the proposed service that I am planning to launch is available, you may consider whether it's something that you should join or not. But hopefully this video will give you basic framework regardless, and it will also allow you to do your due diligence and whether this is something that you want to pursue any further, or really it's not meant for you, and that will be quite acceptable, and individuals will need to make that decision themselves. So I will end the video here. Thank you for your time, and I'm very hopeful that this has been a huge help to you, both in becoming informed and in gaining some basic understanding on which you can then begin to build for the future. Thank you.